My name is Zach. I'm the co-founder of one of the largest accelerators in the world, Startup Bootcamp. And I cover the Africa operations. And I've recently launched a Pan-African venture capital fund focused specifically on seed investments called Launch Africa. I've lived in South Africa for the last 10 years, and I'm a strong believer in the importance of early stage venture capital to uplift innovation on the continent. So I just want to move my slides ahead. Just wondering how I go to my next. Okay, could I move to the next slide? Okay. I'm not particularly sure how I move to the next slide. Hold on. Christine, are you able to help with? Okay, okay, there you go. Sweet, perfect. Okay, about 15 years ago, I was sitting at the Stanford Business School getting my master's degree, and there was a professor called Randy Komisar from Silicon Valley, and he said something that shook the core of my being. And he talked about the different risks that we face in our life. And he said this: the most dangerous risk of all is the risk of spending your life not doing what you want, on the bet that you can buy yourself the freedom to do it later. So I'd encourage you all to just pause for a little bit and think about the different things that we do in our lives, and how many of us are truly following our calling, our passion, what motivates us, and how many of us are doing jobs we don't like just because it pays the bills, and one day eventually we can buy ourselves time and the freedom to do that one big thing later. And that's why entrepreneurship is a lonely road. It's not something that everyone understands, but it's the ability to step outside your comfort zone despite what people say against you, and do something that you truly love and believe in and solve problems. So it's something that hit me very significantly when I was a young kid getting my master's at the age of 22 in the heart of Silicon Valley. When I moved to Africa 10 years ago, I spent about 10 years as an investment banker on Wall Street, and moved to Africa almost by chance to watch the World Cup in 2010. And there was one fact about the African population growth that made me understand the huge potential for venture on the continent. So the population of Africa is growing exponentially higher than anywhere else in the world. And by the turn of the 21st century, Africa will account for 1 in 3 people on the continent. So that is either a massive infrastructural and logistical challenge or a big opportunity. And I've always looked at the glass half full. So Africa has been ready for technological disruption for several years now, but the last 3 to 5 years, specifically from a venture perspective, have provided an incredible amount of opportunity. So when I first came to Africa 10 years ago, the total amount of investment into venture capital was only around $20 to $25 million. And if you fast forward that just 8 years, in 2019, that number sat at over $2 billion. So from a growth perspective, the African VC industry is growing faster than any other region in the world. And what's interesting is not only is the amount of investment increasing, the number of rounds and the number and the amount of investment per round is also going up. And what you'll notice a lot of is, when it comes to Series A and Series B rounds in Africa, the average valuations that startups get, irrespective of sector, is on par with what you would see in the US or the Americas. So it's an important fact to note that the biggest gap in Africa at the moment is just at the seed stage, where a lot of sort of investment capital is still the doyen of friends and family. Just going on to the next slide. 2019, like I said, was a record-breaking year for Africa VC. Most of the VC on the continent tends to be split between Nigeria, Kenya, South Africa, and Egypt, but it is very encouraging to see secondary markets like Francophone West Africa, markets like Senegal, Morocco, Dakar, Abidjan in Cote d'Ivoire, etc., getting an increasing sort of the appetite for VC in these markets has significantly gone up. And in other regions of East Africa, like Rwanda and Uganda, you're seeing an increased importance in technology-driven VC. One of the reasons a lot of people have asked me why I moved to South Africa and why I spend so much time in Nairobi and Lagos, and why are Nairobi, Lagos, and Cape Town the hotbeds for innovation on the African continent. It's important to understand, take a step back and understand what are some of the key components that make an ecosystem a thriving ecosystem. So what makes Silicon Valley Silicon Valley? What makes Berlin a great city for innovation, but Frankfurt not so much? What makes Bangalore a city for innovation, but not Delhi? So and as you go through these 5 points, it's important for you, wherever in the world you are, to think of whether the city that you live in has these points. So you need to have talented, tech-savvy entrepreneurs, not just developers, but you also need designers, you need digital marketing people, and you need people that graduate from technical universities and start working as founders or supporters in tech startups and not just going into academia and corporate. Silicon Valley has a lot of that, and you see a lot of that in cities like Nigeria, Lagos, Cape Town, and Nairobi. The second thing is risk capital. Startup systems, startup ecosystems that have a good pool of risk capital and not just capital. So it's the attitude towards risk that is often more important than just the amount of capital you have. Another key factor is the amount of collaboration that startups have with large corporates. So especially in Africa, I'll get to this in a second. B2C business models are very hard to scale for lots of reasons, but the most obvious one being the cost of acquiring customers in Africa is a lot higher than acquiring customers in the US, because the penetration of internet and mobile services is a lot lower here. That's why it's very important for banks, retailers, insurance companies, and telcos to work closely with startup founders. And you see a lot of that happening now through the fourth point, which is the importance of accelerators, incubators, and entrepreneurial support organizations like Endeavor, Acumen, Ashoka, etc. And then number 5, last but not least, you cannot ignore government. So government's role is to be a supporter of entrepreneurs, not interfering with entrepreneurship. And where government can help is in things like tax subsidies, R&D grants, etc. And you see successful tech ecosystems like I mentioned before, Silicon Valley, Bangalore, Beijing, Estonia, etc. provide that. A few points about how successful entrepreneurs in Africa have made their way up the food chain. Companies like Paystack that recently got acquired by Stripe for $200 million, the Flutterwaves of the world, the Aerobotics, the Pagas, the M-Pesas of the world, is they understand, like I mentioned earlier, the importance of a B2B or a B2B2C business model. And good founders are able to understand how to minimize your cost of acquisition, customer acquisition, and at the very same time minimizing the churn, which indirectly improves your customer lifetime values. These are very important metrics that are not traditionally discussed in private equity and corporate finance. It's very important to, as a founder, to look at running a lot of pilots or POCs, often abbreviated as proof of concepts, where you engage with large corporates simply because large corporates have access to distribution and customers that is very hard to acquire if you do it yourself. So a key thing that I harp on all the entrepreneurs that I've backed, and I've invested in more than 50 of Africa's top tech entrepreneurs, including the likes of Flutterwave, Kudabank, Mpost, etc. So is you have to very early on look at partnering with large corporates. And then last but not least, it is extremely important. I'm almost 40 years old. I grew up in the 80s and 90s, where if you ran a successful company, you would normally compete either on price or quality. So you either made a product that was price competitive or you made something that was very high quality. In today's world, the last 10 years, with the explosion of the internet the shared economy, the gig economy, and um, and marketplaces, the most important commodity that we have, the most precious commodity we have, is time. So, if as an entrepreneur, as a founder, you're able to save people time or make their lives more convenient, you have a much better chance of succeeding than purely competing on price or quality. A quick note on what some of the VCs in Africa, and I can speak for ourselves here, look for when we invest in companies. As always, team is extremely important. At the core, we're always looking for smart founders. We're looking for founders with a previous track record. However, a very important thing to all the founders listening here is there's a very fine line between being arrogant and cocky as a founder and being assertive. So always know to be confident and assertive, but never get to a point where you're not mentorable and not coachable. Investors hate that if you're not mentorable and coachable. Your total addressable market is extremely important. Again, I'm shortening all this down to short sound bites. If you don't have a total addressable market that can grow to at least $100 million by year 5, ideally close to $1 billion, it's it's unlikely that a VC would want to back you. Traction is very important. From a Series A milestone, you should be gunning towards between $50 and $100,000 in monthly recurring revenue before you can even think of doing a Series A. These are all just short tips for the founders here. It's very important to understand IP and patenting your technology. You don't have to be a technology business, but you have to be aware of how technology can help you scale. Um, Another important thing is transformation. A great book to read on this is a book called Zero to One by Peter Thiel, the co-founder of PayPal. You want to see how your idea transforms an industry you work in. To think of companies like Skype and Zendesk and Spotify. Each of them defined a brand new category that allows them to dominate for decades. So you either win a market by being first to market or being the best to market. And that leads into my next point about timing. Timing is one of the most important things to look for, but often the most hard to quantify. Spotify was not the world's first streaming service for music. Neither was Google the world's first engine, a search engine, and neither was Skype the world's first VoIP service. But they timed the market perfectly. And if you're familiar with bell curves, the ideal time to get into a market is after you get validation from your early adopters. So if you're an African founder starting a business, always keep aside some dry powder to get validation from previous entrants that have gotten feedback from customers. And last but not least, because we are a VC, we always look to at least make a 10x on our investments within a 5-year period. Um, some very quick tips for entrepreneurs and other co-investors here. Uh, as a VC, unit economics are super important. So things like EBITDA multiples and break evens are not really relevant for classic early stage VCs like ourselves. Africa tends to be stuck in the private equity mindset. A lot of people joke that traditional VC funds in Africa are essentially private equity funds with smaller checkbooks. I tend to agree. I come from a Silicon Valley mindset, having now lived in Africa for 10 years, where I subscribe to a model where unit economics are the most important thing when you look at early stage VC. So some quick tips here. Always measure the lifetime value of a business versus the cost of acquiring that customer, right? The lifetime value is very simple. It's just the gross profit that you make per user multiplied by the lifetime of that user. And the lifetime is essentially the inverse of churn, right? If your lifetime value to customer acquisition costs is lower than 3, it's very unlikely someone will see how scalable your business is. Another important thing is it's called the rule of 40, which is essentially look at your EBITDA margins, which for the most case are almost always negative, but that's not a problem. Having a negative EBITDA margin is okay because most startups are not profitable for 3 to 4 years. You need to be able to compare as a VC. How does your margin grow over time? So even if you have negative margins, if that negative margin is growing quickly enough, the sum of your actual margin and its growth rate should be at least 40 to make a call. And last but not least, people look at, or at least good VCs in the US look at your growth to churn ratio. That needs to be at least 4 or more. Again, churn, very simple, is a percentage of people that leave over a period of time. So if you're growing at 40% and you're churning at 10%, that ratio is 4, and that's okay, right? And last, to sort of end this off, there's this big overemphasis on valuation. Everyone loves talking about valuation. As an early stage VC and an angel investor, valuation means almost nothing to me, because the only thing about valuation at an early stage is that it is likely wrong or bollocks. The true valuation of a company really only comes when you've achieved product market fit or a problem solution fit. And what is that? That's essentially validation, right? So I don't care how long you've been in business. I don't care how much funding you've received. We've seen tons of companies that have been around for a very long time and are worth diddly squat. We've seen companies that have raised tons of money but are worth nothing. And you've seen the opposite, companies that have raised very little money but are worth a lot of money. So it's, at the end of the day, you're only as valuable as what your validation is. So keeping all this in mind, we've now raised or close to finalizing one of the largest funds in Africa for early stage entrepreneurs, purely seed stage entrepreneurs. It's called Launch Africa, and I'd be very happy to talk to either investors that would like to co-invest and be part of the fund, or entrepreneurs that are looking to raise capital. And I want to end with one of my favorite quotes when I moved to South Africa 10 years ago. If you're an entrepreneur, remember this: it always seems impossible until it gets done. From the late Nelson Mandela. Right. Thank you guys for listening.